Somewhere between the founding fathers' suspicion of paper money and this morning's silver chart lies a truth that Cicero would have recognized instantly. A price is not a fact, it is an opinion, and opinions can be wrong for a very long time before reality collects its debt. This holiday weekend, while the Republic busies itself with sparklers and potato salad, that debt appears to be coming due in the silver market. Quietly, the way most consequential things do, on a day when almost nobody with a television camera is watching. Let us begin with what the ticker tells us, because numbers, unlike politicians, at least have the decency to be precise even when they are being misleading. Silver closed Friday just above $62 an ounce, up roughly 2.5% on the session, having punched through the $61 mark a day earlier in a rally that pulled gold along with it past $4,180. The occasion for this enthusiasm was not a triumph, but a disappointment, the sort of disappointment that markets, in their perverse wisdom, often treat as good news. The Labor Department reported that the American economy added a mere 57,000 jobs in June, against expectations north of 110,000, and then, in the manner of a man confessing a smaller sin only to reveal a larger one, revised the prior 2 months downward by a combined 74,000 jobs. The unemployment rate ticked down to 4.2%, which sounds like triumph until you notice that a portion of that improvement consists of Americans who simply stopped looking for work, a statistical sleight of hand that would have made a Tammany Hall ward boss blush with professional admiration. Markets, sensing weakness in the labor force, promptly recalculated the odds of a Federal Reserve rate increase in September. Before the jobs report, futures traders had priced in something close to a 2/3 probability of a hike. Within hours, that number fell below 50%, a coin flip, which is Wall Street's polite way of admitting it hasn't the faintest idea what happens next. 2 days before that, in Sintra, Portugal, at the European Central Bank's annual gathering of central bankers who speak in riddles for a living, Fed Chairman Kevin Warsh, a man nominated specifically because the markets believed him to be an inflation hawk of Andrew Jackson-like conviction, allowed that inflation expectations had eased. He did not renounce his hawkishness, he merely softened its consonants. But for gold and silver, starved for months of anything resembling dovish oxygen, that was enough. Silver rallied the very session he spoke. This is the surface story, and it is the only story most channels covering this market will bother to tell you, because it is loud, it is fast, and it fits neatly into a headline. But surface stories, like the froth on a wave, tell you almost nothing about the current running beneath. The current, in this case, runs 8,000 miles east to Shanghai, where a number has been sitting quietly for weeks that ought to concern anyone who thinks the price on their phone screen represents anything so grand as the truth. Shanghai spot silver, real metal, physically delivered, no paper tricks, is trading at roughly $68 an ounce. The Western price, the one everyone in New York and London is quoting with such confidence, sits closer to 62. That is a premium approaching 12%, and once you account for China's 13% value-added tax on physical silver purchases, the fully loaded cost for a Chinese buyer walking into a shop with cash climbs well past that already startling gap. Some recent tallies this year have put the all-in premium above 20%. Consider what that means, and consider it the way a jurist considers evidence, rather than the way a headline writer considers a deadline. The Shanghai Gold Exchange, despite its name, is a market where silver actually changes hands. A market of delivery, not of promises. The COMEX in New York, by contrast, is a market where less than 1% of contracts ever result in anyone actually taking possession of a bar of metal. The rest are rolled forward, netted out, and settled in cash, which is a perfectly legitimate way to run a financial exchange, but a rather poor way to discover what silver is actually worth to someone who wants to hold it in his hand. When the market that deals in real metal prices silver 11, sometimes 20% above the market that mostly deals in paper promises, and does so not for a day, but through session after session, holding firm rather than snapping back, that is not noise. That is the physical world quietly informing the paper world that it has stopped believing its press releases. China, remember, consumes something close to 1/3 of the world's industrial silver, feeding it into solar panels, electronics, and an electric vehicle sector expanding at a pace that would have seemed like science fiction to the men who wrote about horseless carriages a century ago. When the country using that much metal is willing to pay a substantial premium simply to secure supply today, rather than wait for prices to normalize, that tells you something about scarcity that the New York quote, for all its confidence, cannot. In theory, this arbitrage opportunity should not exist for long. Buy cheap in New York, ship to Shanghai, sell at the premium, and watch the two prices converge, the way water finds its level. That is Economics 101, taught in the first week of every survey course from Cambridge to Chicago. But China's capital controls restrict how freely money crosses its borders to fund such trades. Import quotas managed by the People's Bank of China limit how much metal flows in, and the simple physics of shipping heavy metal across an ocean eats into whatever profit the arbitrage promised. The friction is real, and because the friction is real, the gap persists. A standing rebuke to anyone who assumes markets always and everywhere clear efficiently, a notion that sounds elegant in a textbook and looks considerably messier in a warehouse in Shanghai. There is a newer wrinkle worth your attention, one that almost no one outside specialist trade publications has bothered to report. The Silver Institute's newsletter, published on the 1st of July, noted the launch back in May of a new physically deliverable silver futures contract out of Singapore, run by an exchange called ABX, requiring silver of 4/9 purity, the exact standard demanded by solar panel manufacturers and semiconductor fabricators across Asia, delivered into approved vaults in Singapore, including facilities operated by Brinks. Firms in Singapore, Thailand, and India are already participating. Read between those lines, as any sensible observer of history should, Asia has stopped merely grumbling about the gap between its physical reality and the Western paper price. It is quietly constructing the infrastructure to price around it entirely, which is precisely the sort of thing empires in decline fail to notice until it is too late to matter. Now let us cross the ocean back to New York, because the story in COMEX vaults this week complicates any narrative, bullish or bearish, that someone might wish to sell you in 90 seconds or less, and complication, however unfashionable, happens to be where the truth usually resides. The most recent daily warehouse report shows COMEX registered silver, meaning metal formally warranted and immediately available for delivery against a futures contract, sitting at roughly 93 million ounces. That is a meaningful climb from mid-June, when registered stocks had fallen to somewhere between 82 and 87 million ounces. Over the back half of June, in other words, registered inventory rose close to 9% in about 30 days. I want to be as candid with you as a founding father drafting a constitutional compromise, because I have watched other commentators seize on this rise and declare the entire tightness narrative a fiction. That is not an honest reading of the ledger. Registered and eligible silver are two different categories, as distinct as a promise and a delivery. Eligible silver meets COMEX's purity and weight standards, but has not been formally committed for delivery. Registered silver has been committed and can move against a contract immediately. When registered inventory rises while total combined stocks remain roughly flat, the most plausible explanation is that metal owners are converting eligible bars into registered status, making more of what they already hold available for delivery, likely in anticipation of demand around the July contract's delivery window, rather than new supply materializing from thin air. This is bookkeeping, not abundance. Context, as any student of history knows, is the difference between information and wisdom. Go back to 2024, when COMEX registered silver peaked near 190 million ounces. Even after this month's rebound into the low 90s, the current registered pool remains less than half of where it stood 2 years ago. The long arc, notwithstanding this short-term bounce, still points toward a shrinking deliverable pool, a fact that should temper both the bull's euphoria and the bear's dismissal in roughly equal measure. And then there is open interest, the figure that professional trading desks watch closely and everyone else ignores, generally to their detriment. Recent data on the July contract shows open interest running around 50,000 contracts. At 5,000 ounces per contract, that works out to somewhere between 250 and 270 million ounces of paper claims sitting atop a registered pool that is currently a fraction of that size. That coverage ratio is not, under ordinary circumstances, a crisis, because the overwhelming majority of those contracts will be rolled forward or settled in cash rather than standing for physical delivery. But it is tighter than it has been in years, and tight coverage ratios are precisely the condition under which a routine delivery month can become something considerably less routine, should even a modest fraction of that open interest decide it would prefer bars to promises. So here, without embellishment, is the honest state of affairs in New York. Registered inventory has bounced, and that is real. But it sits atop a pool still dramatically smaller than it was 2 years ago, beneath a mountain of paper claims that dwarfs it many times over. That is not collapse. It is not comfort, either. It is a system operating with considerably less margin for error than it once enjoyed. The financial equivalent of a bridge rated for a load it has not carried in some time, still standing, but worth watching. Which brings us to the deficit that does not care about any of this, not the jobs report, not Kevin Warsh's choice of adjective in Sintra, not the weekly churn of registered versus eligible bookkeeping in a New York vault. The Silver Institute's most recent World Silver Survey puts this year on pace to be the sixth consecutive year of a global silver supply deficit, and the shortfall is not narrowing. It is widening, landing around 46 million ounces for this year alone, even as industrial demand from certain sectors, solar chief among them, has cooled slightly as manufacturers learn to use less silver per panel. The cumulative drawdown from above-ground inventories since 2021 now approaches 800 million ounces, metal pulled from the world's stockpiles simply to bridge the gap between what is mined and what is consumed. That is not a figure that resets, because a central banker softened his tone on a stage in Portugal. Here's the structural reason why. Somewhere between 70 and 75% of the world's silver does not come from primary silver mines at all. It arrives as a byproduct of mining copper, lead, and zinc, which means silver supply is not really governed by the silver price, but by decisions made in entirely separate commodity markets. If copper producers are not expanding output, the silver that would have ridden along with it simply does not appear, no matter how high silver itself climbs. A bit like discovering that the tributary you depend upon is controlled by a dam 100 miles upstream, operated by men with no particular interest in your harvest. And building a new primary silver mine, from discovery to production, can consume the better part of a decade once permitting, financing, and the inevitable community opposition in Peru and Mexico, the world's two largest silver-producing nations, are accounted for. Demand, meanwhile, shows no inclination toward mercy. Solar photovoltaic manufacturing alone consumes more than 150 million ounces of silver annually, even after considerable efficiency gains. Electronics, electric vehicles, fifth-generation wireless infrastructure, and now the vast, humming build-out of artificial intelligence data centers are all layering additional, largely inelastic demand atop that base. These are not speculative flows that evaporate the instant a Federal Reserve governor adjusts his rhetoric. These are production lines, government-mandated solar targets, and multi-year manufacturing contracts running on their own schedules, entirely indifferent to the monetary policy calendar in Washington. Before we go further, I want to say something directly to you, because I suspect a fair number of you have watched market commentary before and been burned by someone selling certainty where only probability exists. If you have found this breakdown useful, if pulling apart the Shanghai premium from the COMEX bookkeeping from the structural deficit has given you a clearer picture than the headlines offered, the subscribe button costs you nothing, and it is the only thing standing between you and missing the next moment when a number like this quietly changes everything before anyone else notices. I would rather earn that subscription than beg for it, but I will admit I want it, because the alternative is watching good analysis disappear into an algorithm that rewards noise over signal, and that would be a genuine shame for both of us. Now, a channel that shows you only the case for the bulls is not practicing analysis. It is practicing salesmanship, wearing analysis as a costume, and I have no patience for either the costume or the men who wear it. So let us examine, with the same rigor we have applied to everything else, where this thesis could simply be wrong. If the June jobs report proves to be a temporary aberration rather than the start of a trend, and labor markets have humbled forecasters before, going back to Harry Truman's famous newspaper headline, then upcoming employment and inflation data could easily come in hotter than expected, and the Federal Reserve's hawkish case would recover its footing quickly. The Fed under its current leadership has been deliberately sparing with forward guidance, declining to publish the kind of dot plot markets grew accustomed to under previous chairs, which means investors are navigating with less light than they are used to, and darkness cuts in both directions. A single hot inflation print could send that September rate hike probability back above 50, back above 60%, and every point it climbs makes a non-yielding asset like silver less attractive relative to cash and short-term treasuries paying a real, guaranteed return. The dollar deserves equal scrutiny. Silver is priced globally in dollars, and any sharp rally in the greenback, whether born of a genuine flight to safety or a hawkish surprise from the Fed, creates real headwinds, precisely as it did in 2022, when a surging dollar index hammered the entire metals complex without mercy for bulls or bears alike. And on the Shanghai premium specifically, a note of humility is warranted. Such premiums have narrowed before, without any accompanying global price surge. Should Chinese import quotas loosen, or domestic demand cool alongside a broader economic slowdown there, that gap could close quietly, without ever forcing New York to catch up to it. A persistent regional premium is a signal worth watching closely. It is not a guarantee of what happens next, and anyone who tells you otherwise is selling something other than analysis. So, here is your list, plain and unadorned, for the week ahead, once the holiday quiet lifts and volume returns to this market in earnest. Watch whether the Shanghai premium holds, widens, or begins to compress once Chinese trading normalizes following its own upcoming data releases. A premium that survives multiple sessions in a row tells you considerably more than a single day's spike. Watch the next round of American inflation and employment figures, because that is what will determine whether Chairman Warsh's softer tone in Sintra marked the beginning of a genuine shift or merely a single moment of uncharacteristic nuance from an otherwise hawkish man. Watch COMEX registered inventory day by day. If it continues rising purely because eligible metal is converting to registered status ahead of the July delivery period, that is a technical adjustment and nothing more. If total combined stocks begin declining as well, that is real metal leaving the system entirely, and that is a considerably different story. And watch the gold-silver ratio, which has been compressing from elevated levels earlier this year. Further compression, should silver hold its recent gains, is historically one of the clearer signs that silver is beginning to close the distance with gold rather than merely trailing in its shadow. Here, then, is the honest summary, offered without the false comfort of certainty that lesser commentary traffics in. A weak jobs report and a Federal Reserve chairman's softened syntax gave silver its latest leg higher this week. That is the monetary story, and it is genuinely fragile. It could reverse with the next data release, the way fortunes have reversed in markets since the Dutch tulip mania taught the West its first hard lesson in the difference between price and value. Beneath that noise sits a physical market in Shanghai that has, for weeks, been quietly telling anyone willing to listen that real silver is scarcer and dearer to obtain than the Western paper price cares to admit. Beneath that sits a COMEX system with considerably less deliverable cushion than it possessed 2 years ago, even accounting for this month's bounce. And beneath all of it sits a 6th consecutive year of a global deficit that does not consult central bankers, does not read newsletters from Sintra, and does not particularly care what tone anyone strikes on a stage in Portugal. The paper price moves on headlines. The physical reality beneath it simply keeps grinding forward, the way rivers do regardless of what the map makers draw. And that gap between the two, quiet, persistent, unglamorous, is usually the story that matters most once the headlines have already moved on to something else. I would genuinely like to know what you make of all this, and I mean that more than the customary closing courtesy usually suggests. Do you think Shanghai is finally forcing New York's hand, the way physical reality eventually forces every paper fiction to reckon with it? Or is this simply another premium that fades quietly once trading normalizes and the holiday crowds go back to work? Tell me in the comments and tell me why. I read every one, and the best arguments down there have shaped more than one of these breakdowns before the cameras ever rolled. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.